Well, this week's interest rate hike, which was announced just yesterday by the South African Reserve Bank, will have a huge impact on the property sector. Bond originator Tim Akinnusi, who is the CEO of Mortgage Market, he says the central bank, this is what the property market is facing, with the central bank adding another 75 basis points to the repo rate, taking it up to 7%. This means homeowners and motorists will have to dig deeper into their pockets to cover the costs of their homes and, of course, their vehicles. Akinnusi is joining me now for more on this. Good afternoon, Akinnusi. Welcome today. It is a day after, and we expected, of course, the Reserve Bank yesterday to hike the repo rate. It's now standing at 7%. That means the commercial banks are going to follow suit. The cost of borrowing has now gone up. From a mortgage market perspective, what is going to be the real impact here?
Yeah, Dan, thanks for having me. It has gone up effective immediately, and quite simply, as much as this has been expected, it does not limit the sting that homeowners will face immediately as their mortgages get repriced. Of course, this is also sector dependent, so we expect that the affordable housing segment will see a potential increase of about sort of 350 Rand more on their monthly repayment. And we're talking about homeowners now that have property valued at about 750,000 Rand to the 600,000 Rand mark. But the real sting is to the folks who have mortgages north of 2.5 million to 3.5 million to repay on a monthly basis. That sting is about 1,500 Rand immediately on their monthly repayment. So yeah, this has been expected. We've had a total now of 7 consecutive hikes since November last year, and we are now back to the levels that we were seeing in 2017, which is a rate of 10.5% on the prime lending rate.
Do you think this will dampen appetite for those who want to acquire property?
Well, Dan, if you are acquiring property for a primary residence stake, I think that this simply means that you need to reprioritize your spending and focus more on what matters the most, which is getting property and repaying back the good debt. But if you are looking at investment property, this might also play into you, because individuals who are looking to buy a house in a category of 1.5 to 3 million might want to just hang tight and see where the next rate hike potentially goes to, which will mean that they'll continue to rent property, which means that the rental yield rate would be very attractive for property investors who are looking to get into long-term leases and purchase property for that purpose. So I think that what we are seeing is a mixed bag, and I think it has to do with the intention of how home buyers are seeing the market. The view for me is that in the next couple of months, we really need to show the Reserve Bank something fundamentally different by cutting our expenditure, and hopefully this breaks the back of inflation, which is really the target that the Reserve Bank is trying to get to bring this thing back down to a level of about 6% If we can do that, then potentially the Reserve Bank will consider a smaller rate hike in the next cycle, or even surprise us with just leaving it flat. So yeah, that's the best that we can hope for at this stage.
Yeah, in the property market, I mean, on the commercial side of things, I mean, is there an impact? I mean, most businesses own huge segments of office space and stuff. Don't know, depending how they've been funding it from a property development perspective. Is there an impact here on that sector of the market?
I think there would be, especially if the landlords of commercial real estate are holding some debt against that. Especially if those places aren't being let out as well. But I think that the impact will be a lot less severe, given that, in that segment, it's a lot more resilient. And if you are a business owner and you need the space, you are likely to continue to trade and maybe pass on that cost to your customers further down the line. But we don't expect anything dramatic in that space. It's more to the average individuals who have, high interest loans. They will feel the pinch immediately, and they will react the most.
Yeah, outlook-wise, the governor yesterday saying that, of course, they are trying to rein in inflation into the future. You can't do much about nothing about what happened last month and the month before. What's your outlook? I mean, if they manage to rein in inflation in terms of the property market, what's the outlook?
The outlook is going to be, if this gets reined in, then the relief will be there for potential home buyers to want to step into the market because they have a potential level of stability in terms of how they're seeing the outlook. The banks as well would take a view to not continue to hike more interest rate buffers on the affordability of those customers, because they would then price in that this is likely to have been the peak of the interest rate cycle, and maybe it's going to be a stable environment and potentially a decline. So they will start to look at that and perhaps maybe give more relief to individuals who are looking to get into the market and need some level of affordability to be able to make their home mortgage work. So let's try to be positive about it, and I think it all depends on how we spend over the next couple of months. That will determine whether or not we can break the back of inflation and stem the tide of these continuous rate hikes.
And barring any unexpected development, like somebody deciding to invade another country, let's hope we'll be spared the uncertainty and the volatility that comes with that. Thank you very much, Tim Akinnusi, the CEO of Mortgage Market.